You picked up a side hustle in retirement to make ends meet, but that extra cash might secretly be triggering an IRS penalty that completely wipes out your earnings. If you are a retiree bringing in outside money right now, whether that is from consulting, gig work, or selling crafts online, there is a massive tax trap waiting for you next April, and it has already cost countless seniors a devastating chunk of their hard-earned nest egg. You thought you were just padding your savings to fight inflation, but there is a very specific, perfectly legal way you must structure this income, or else you risk triggering a domino effect that taxes your Social Security benefits and skyrockets your healthcare costs. Right now, everything is getting more expensive, from groceries to property taxes. And it makes total sense that you would want to use your decades of experience to generate a little extra breathing room in your budget. I completely understand that instinct. It is responsible, and honestly, it should be rewarded. But the tax code is not designed to be fair. It is designed to be followed. My goal today is to walk alongside you step by step and show you exactly how the IRS views your side income differently than the wages you earned during your career. We are going to cover the specific forms you are likely missing, the hidden surcharges that can blindside you, and how you can keep the money you are working so hard to earn right now. Let us start with one of the biggest shocks retirees face when they start bringing in independent income, and that is the reality of the self-employment tax. When you worked as an employee for 30 or 40 years, you saw Medicare and Social Security taxes coming out of your paycheck. What you might not have realized, or perhaps just forgot because it was handled automatically, is that your employer was matching those taxes behind the scenes. You paid your half, and they paid their half. But when you step into retirement and decide to do some freelance consulting, or drive for a rideshare service, or sell your woodworking projects at local fairs, the IRS suddenly views you as a business owner. You are no longer just the employee, you are the employer too. This means you are now responsible for both halves of those FICA taxes, which totals 15.3% of your net earnings. Imagine you make $10,000 from a side gig this year. Before we even talk about your standard income tax bracket, you automatically owe over $1,500 right off the top just for the self-employment tax. For a retiree on a fixed income, suddenly finding out you owe $1,500 you did not plan for can be completely overwhelming. You might assume that because you are already receiving Social Security and Medicare benefits, you do not have to pay into those systems anymore. That is a very common and very costly misconception. The IRS does not care that you are already drawing benefits. If you are earning active income through a trade or business, they are going to collect that 15.3% on every single dollar of profit. The only way to soften this blow is to meticulously track your business expenses so you are only paying tax on your true profit, not your gross revenue. But we will get into the exact mechanics of deductions a little later on. Now let me ask you a question. When was the last time you actually looked at the tax withholdings on your pension or your Social Security payments? If you are like most people, you set it and forgot it the day you retired. This brings us to the second major trap, which is failing to understand the pay-as-you-go nature of the American tax system. When you have a traditional job, your employer withholds taxes from every paycheck and sends it to the government for you. When you have side income, nobody is withholding anything. The company paying you as an independent contractor gives you the full gross amount and reports it to the IRS on a Form 1099. The IRS knows you got that money, and they expect their cut. Here is a staggering statistic to think about. Millions of taxpayers are hit with underpayment penalties every single year simply because they waited until April to pay their tax bill. The IRS requires you to pay taxes on your income as you earn it throughout the year. If you expect to owe more than $1,000 in taxes when you file your return, you are generally required to make quarterly estimated tax payments. If you start a side hustle in January and make a bunch of money, but you do not send the IRS a dime until the following April, They are going to slap you with an underpayment penalty plus interest for the months you held on to their money. To protect yourself from this, you need to understand the safe harbor rules. The IRS says you will not face an underpayment penalty if you pay at least 90% of the tax you owe for the current year or 100% of the tax shown on your return for the prior year, whichever is smaller. If your income is over a certain threshold, that 100% rule jumps to 110%. What this means in plain English is that you have a couple of options to avoid this penalty. You can either sit down 4 times a year, calculate your exact profit from your side gig, and mail a check to the IRS using Form 1040-ES. Or, if you want to make your life infinitely easier, you can simply adjust the tax withholding on your other sources of retirement income. If you are drawing a pension or taking distributions from a traditional IRA or 401k, you can contact your plan administrator and ask them to withhold more taxes from your regular payouts. You can even submit a Form W-4V to the Social Security Administration to have a flat percentage of your benefits withheld for taxes. By increasing your withholdings on the income that is already automated, you can cover the tax liability of your side hustle without ever having to remember to mail in quarterly checks. This single strategy can save you from a massive headache and keep those penalty fees safely in your own pocket. But as important as those estimated taxes are, they are really just the tip of the iceberg. The way your side income interacts with your Social Security benefits is where the math gets incredibly dangerous. I want to spend some time breaking down what financial advisors call the Social Security Tax Torpedo. When you originally retired, you might have calculated your budget, assuming your Social Security benefits would be tax-free. And for some people with very low overall income, they are. But the IRS uses a formula called provisional income to determine how much of your Social Security is subject to federal income tax. And this is where your side hustle can absolutely betray you. To find your provisional income, the IRS takes your adjusted gross income, adds in any non-taxable interest you might have from municipal bonds, and then adds half of your Social Security benefits. If you are single and that number stays under $25,000, or if you are married filing jointly and it stays under $32,000, your Social Security is entirely tax-free. But the moment your provisional income crosses those lines, up to 50% of your benefits become taxable. And if your provisional income crosses $34,000 for a single person or $44,000 for a married couple, up to 85% of your Social Security benefits become subject to federal income taxes. Let us think about what that actually means in the real world. Let us say you and your spouse are living comfortably, and your provisional income is sitting right at $43,000. You decide to take on a consulting project that pays you just $2,000. You assume you will just pay your standard income tax rate on that $2,000, maybe 22%. But because that $2,000 pushes your provisional income over the $44,000 threshold, it does not just add $2,000 to your taxable income. It suddenly drags thousands of dollars of your previously tax-free Social Security benefits into the taxable category. You are essentially being taxed twice on the same side hustle, once on the earnings themselves, and a second time because those earnings caused your Social Security to become taxable. The marginal tax rate on that specific $2,000 of side income can effectively spike to 40% or higher because of this torpedo effect. This is why it is incredibly important to map out your income before the year ends, not after. If you see that your side income is about to push you over one of these cliffs, you need to look for ways to reduce your adjusted gross income immediately. This might mean deferring some of your side gig income to the following year if your clients are willing to wait to pay you. It might mean maximizing your deductible business expenses to lower your net profit. Or it could even mean making a deductible contribution to an IRA if you are still eligible to do so. The point is, you cannot afford to view your side income in a vacuum. It is deeply intertwined with every other piece of your retirement puzzle, and failing to manage that connection will cost you dearly. And speaking of deductible business expenses, we need to have a very serious conversation about how the IRS classifies your side activity. Many retirees start making money from things they are genuinely passionate about. Maybe you love restoring classic cars, or breeding show dogs, or painting landscapes. If you start selling these things, it is completely natural to think of it as a small business. You buy supplies, you pay for marketing, you travel to trade shows, and you deduct all of those costs against the income you make. But the IRS is highly suspicious of taxpayers who try to write off the expenses of their personal hobbies. Under Section 183 of the Internal Revenue Code, often referred to as the hobby loss rule, the IRS draws a very strict line between a legitimate business and a hobby. If the IRS audits you and determines that your side hustle is actually a hobby, the consequences are disastrous. Under current tax law, you are required to report every single dollar of income you make from a hobby, but you are not allowed to deduct any of the expenses you incurred to make that money. Let me repeat that because it is vital. If your activity is classified as a hobby, you pay taxes on the gross revenue and your expenses mean absolutely nothing. Let us say you spend $5,000 on supplies and materials to create custom furniture, and you sell that furniture over the course of the year for $6,000. In your mind, your profit is $1,000. You think you only owe taxes on $1,000. But if the IRS classifies your furniture making as a hobby, they will force you to pay income tax on the entire $6,000 of revenue, completely ignoring the $5,000 you spent. It is a mathematical nightmare that can leave you owing more in taxes than you actually netted in cash. To protect yourself from the hobby loss rule, you have to prove to the IRS that you are operating with a genuine profit motive. The easiest way to do this is to actually make a profit in at least 3 out of 5 consecutive years. If you do that, the IRS generally presumes you are a business. But if you are taking a loss year after year, you have to work much harder to prove your intentions. You need to operate in a business-like manner. This means keeping completely separate bank accounts for your side hustle and your personal finances. It means maintaining meticulous books and records. It means consulting with experts to improve your profitability and perhaps even changing your business model if your current one is not working. You must document that you are actively trying to make money, not just subsidizing your favorite pastime with tax write-offs. Treat your side gig with the professional respect it deserves and make sure your paper trail proves it. Now, we have covered the self-employment tax trap, the estimated tax penalties, the Social Security Torpedo, and the catastrophic hobby loss rules. If you can navigate those 4 hurdles, you are already doing better than the vast majority of working retirees. But in just a moment, I'm going to reveal the silent, delayed penalty that catches almost everyone completely off guard. It is a hidden surcharge tied directly to your health care, and making just $1 over the wrong limit can literally cost you thousands of dollars years after the fact. It is perhaps the most unfair rule in the entire tax code, and you need to understand it before you bill another client. But before we get to that, let us talk practically about how you track everything we have discussed so far. A lot of folks reach retirement and think they can finally throw away the complicated spreadsheets and just enjoy life. But if you are generating self-employment income, your record keeping actually needs to get better, not worse. Every time you drive your personal vehicle for your side hustle, you need a mileage log. The IRS standard mileage rate is generous, but without a contemporaneous log detailing the date, the destination, the business purpose, and the miles driven, an auditor will throw those deductions out the window. Every time you buy a piece of equipment, you need to decide whether to deduct it all at once using Section 179 or bonus depreciation, or spread it out over several years. You have to start thinking like a chief financial officer, even if your business is just you sitting at a kitchen table with a laptop. The cost of getting this wrong is not just financial, it is profoundly emotional. There is nothing quite like the pit in your stomach when you open a letter from the Department of the Treasury. You worked your entire life to reach a point of security and peace of mind. You took on this extra work because you wanted to feel empowered and secure against the rising cost of living. To have that sense of security shattered by a confusing IRS notice demanding back taxes, penalties, and interest is a terrible burden to bear. I do not want you to experience that anxiety. That is why taking the time right now to organize your books, consult with a qualified tax professional, and implement these strategies is an act of profound self-care. It protects your peace just as much as it protects your portfolio. And this brings us to the ultimate trap, the silent killer of retiree side income. Let us talk about Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. When you were enrolled in Medicare Part B, which covers your doctor visits, and Part D, which covers your prescription drugs, you pay a standard monthly premium. But the government has decided that higher income retirees should bear more of the actual cost of the Medicare program. If your modified adjusted gross income exceeds certain thresholds, the government slaps a surcharge on top of your standard premiums. This is IRMAA. The reason IRMAA is so dangerous is because it operates on a cliff system and it has a 2-year lag. Let me explain exactly how this works because it is crucial. The Social Security Administration determines your IRMAA surcharge by looking at your tax return from 2 years ago. So the side income you earn in the current year will not affect your Medicare premiums next year. It will hit you the year after that. This delay creates a massive blind spot for retirees. You might have a fantastic year with your consulting business right now, pay your taxes on it, and think you are in the clear. Then, 2 years from now, you suddenly get a notice that your Medicare premiums are jumping by hundreds of dollars a month. But the cliff system is the truly terrifying part. Unlike regular income tax brackets, where you only pay the higher rate on the dollars that fall into that specific bracket, IRMAA is all or nothing. If the threshold for an IRMAA surcharge is, say, $103,000 for a single person, and your modified adjusted gross income comes in at $103,001, you do not just pay a little extra. That single dollar pushes you completely off the cliff and into the surcharge tier. You and your spouse could suddenly be on the hook for an extra $2,000, $3,000, or $4,000 a year in Medicare premiums, all because of one single dollar of excess income. Imagine grinding out an extra weekend of freelance work, bringing in $500 and feeling great about it. But because that $500 pushed your total income over an IRMAA cliff, your healthcare costs for the entire year jump by $3,000. You literally lost money by working. That side hustle did not just fail to make you richer, it actively made you poorer. To defend yourself against IRMAA, you must be ruthlessly precise with your year-end tax planning. You need to know exactly what the IRMAA brackets are for your filing status, and you need to project your modified adjusted gross income before December 31st. If you see that you are getting dangerously close to a cliff, you must take evasive action. This might mean making larger charitable contributions if you itemize, utilizing a donor-advised fund, or, again, looking for any legitimate business expenses you can accelerate into the current year to lower your net profit. If you are doing Roth conversions, you have to calibrate them perfectly so the converted amount, combined with your side income, does not accidentally throw you over the edge. Now, there is one small beacon of hope with IRMAA. If you experience a life-changing event, you can appeal the surcharge. The Social Security Administration recognizes a specific list of life-changing events, including marriage, divorce, the death of a spouse, or a work stoppage or reduction. If you officially retired this year and your income dropped significantly compared to 2 years ago, you can file Form SSA 44 to request that they base your premiums on your current lower income rather than the high income from your working years. But here's the catch. Voluntarily starting a side hustle and making too much money is not a life-changing event. You cannot appeal an IRMAA surcharge just because you failed to plan for the tax implications of your gig work. You are strictly on the hook. We have covered a tremendous amount of ground today, and I know this can feel like an overwhelming puzzle. It is completely unfair that trying to stay productive and financially secure in retirement comes with such an incredible amount of red tape. But ignoring these rules is not an option. Hope is not a strategy when it comes to the IRS. To summarize what you need to do immediately. First, recognize that your side hustle subjects you to the 15.3% self-employment tax, meaning you are paying both the employee and employer share of FICA taxes. Second, you must stay ahead of the estimated tax trap. Review your safe harbor requirements and adjust the withholdings on your pension or Social Security right now to avoid underpayment penalties next April. Third, closely monitor your provisional income. Do not let a few $1,000s of side income trigger the Social Security Tax Torpedo and force you to pay taxes on up to 85% of your hard-earned benefits. Fourth, treat your side hustle like a real business. Keep pristine records, separate your finances, and demonstrate a clear profit motive so the IRS never tries to classify your work as a hobby and disallow all your crucial deductions. Finally, beware the delayed, devastating cliff of Medicare IRMAA. Watch those income thresholds like a hawk, because making just one extra dollar can cost you thousands in healthcare premiums 2 years down the road. You worked too hard for your retirement to let a preventable tax mistake steal your security. I want to hear directly from you about how you are navigating this. Have you ever been blindsided by a tax bill from your side income? Or have you found a strategy that works perfectly for keeping your taxes low in retirement? Comment your experience down below so we can all learn from what you have been through, and I will see you in the next discussion.